Let's face it, most people want to save as much money as possible in taxes without getting into trouble by the IRS. There are a lot of strategies people use to try to do this, but some of these strategies are just better than others. So today I'm going to break down the most overrated and underrated tax strategies. Without further ado, let's dive in. Let's start with the overrated tax strategies. Using the simplified method for the home office deduction. In 2025, millions of people are working from home. And during the COVID pandemic, a lot of people simply got used to working from home, and many of them have continued to do so. It is true that if you're a business owner and if your home is your primary place of business, then yes, you might be able to qualify for the home office deduction. However, a lot of people don't realize that there are two different ways to calculate this deduction, and one of them can actually lead to a substantially higher deduction than the other. The two ways are the simplified method and the regular method. The simplified method allows a flat deduction of $5 per square foot of home office space, up to a maximum of 300 square feet, resulting in a maximum deduction of $1,500 per year. Womp, womp, womp. This method is easy to use, it requires minimal record keeping, and you only need to know the square footage of your home office. It's simple. However, the $1,500 cap can be very low relative to the regular method, which is why many people view this deduction as being overrated. With the regular method, you deduct the actual expenses related to your home office, prorated based on the percentage of your home used for business. For example, if your home office space is 10% of your total home square footage, you can deduct 10% of eligible expenses like utilities, rent, mortgage interest, insurance, property taxes, repairs, and yes, even depreciation. This method requires more detailed record keeping, but the deduction can be significantly larger than the simplified method, and in fact, it's often 2 to 4 times larger, or even more depending on the size of your home and other factors. Next is adding a vehicle to your business. When this strategy is done correctly, it's great. It's nothing wrong with it. But the reason I'm adding it to the overrated list is because a lot of people try to do this strategy incorrectly. For example, they add a 6,000-pound vehicle onto their balance sheet through their LLC or their S corporation because they think they'll be able to write off the entire cost of the vehicle under Code Section 179 and bonus depreciation in year one, even though they almost never drive the damn car. Guys, listen, this is a massive mistake, and it can absolutely be a major red flag for the IRS in an audit. Here's what I need you to know. You're only allowed to use Section 179 and bonus depreciation for your vehicle if you drive it at least 50% of the time for business purposes. So if you're not going to be using your vehicle at the end of the year at least 50% of the time for business, or throughout the year at least 50% of the time for business, then you shouldn't even think about trying to use Code Section 179 or bonus depreciation for it. Remember that. Next, automatically claiming the standard deduction as if it's gold. Ever since the Tax Cuts and Jobs Act of 2017, the standard deduction has increased significantly. In fact, for tax year 2016, the standard deduction was only $6,300 for single filers. Now it's $15,750. For joint filers in 2016, it was $12,600. Now it's $31,500. Because it has increased so much, a lot of people make the mistake of thinking that choosing the standard deduction instead of trying to itemize is automatically going to be the best decision. But here is the reality. Automatically claiming the standard deduction can be a bad idea. This is because it may cause you to overlook potential savings with the itemized deductions. The standard deduction, it's convenient, it's quick, it's a fixed amount that reduces your taxable income, but if you're eligible to itemize expenses like mortgage interest, state and local taxes if you're in a state that taxes you if you own a property, medical expenses, charitable donations, this can add up to be more than the standard deduction. So itemizing could actually be the better option for you. By simply defaulting to the standard deduction without doing the math, you might be leaving money on the table. And this is highly relevant for homeowners, people with high medical bills, or those who are just making substantial charitable donations. All of these people can have a higher chance of reducing their tax bill by itemizing their deductions instead of just choosing the standard deduction. So what do they have to do? Take the time to compare both options, ensure that you're not paying more in taxes than necessary. If you need any help doing this, you can always consult a tax professional by clicking on the link below. All right, let's move on to the most underrated tax strategies. Oil and gas investing, easily. Most people out there don't even realize that oil and gas investing is a tax strategy, but it is. This is because the IRS gives incredible tax benefits to the oil and gas sector. Why? One major perk is that intangible drilling costs like labor and supplies can be fully deducted in the first year. even if your oil well doesn't produce. These costs typically represent about 60 to 80% of a well's cost. Tangible costs like equipment, things you can tangibly touch, are also fully deductible, but they're usually depreciated over 7 years. However, we have bonus depreciation. With bonus depreciation from the Big Beautiful Bill, you can write off these costs in 1 year. That makes oil and gas investments even more appealing from a tax perspective. Also, if a well is successful, investors can claim a 15% depletion allowance, which means 15% of the oil or gas income is tax-free under certain circumstances. If you have a working interest in an oil or gas well, you can also use losses from the investment to offset active forms of income such as your W-2 or your 1099 income. This is a powerful tax benefit. These tax breaks can lead to massive amounts of savings over multiple years. Now, this next one I bet you probably haven't heard of, or maybe you have, but you haven't put too much time to consider it. Bitcoin mining. This is another tax strategy that is absolutely slept on by most people because it's extremely beneficial, but they don't understand it. The restoration of 100% bonus depreciation makes this strategy more powerful to me. Here's how it works. You can invest in a Bitcoin mine, get 100% bonus depreciation deduction for your mining equipment in year 1. Then you can continue to earn Bitcoin year after year. And I like this strategy because you get an absolutely massive year 1 tax write-off, and then you could just earn income in the form of Bitcoin distributions the year after. Many people were highly critical of Bitcoin in the first 10 years of its existence. However, it has come a long way since then. And now hundreds of large corporations and companies are adding Bitcoin to their corporate treasuries. There are also massive Bitcoin ETFs worth tens of billions of dollars run by some of the largest financial institutions in the entire world. The regulations have become much more favorable for Bitcoin and crypto, and Bitcoin has over 100 million users. So yes, it's a completely different animal than what it was 10 years ago. And investing in Bitcoin mining is very similar to owning rental real estate. This is because you get a huge write-off, you get cash flow, and the underlying asset tends to appreciate substantially in value over time. Bitcoin might be a little bit more volatile than real estate, but its overall trend has been up. Crucially, with a Bitcoin mine, you get to claim all of your depreciation year 1, whereas with real estate, even though you can do a cost segregation study, there's still portions of the real estate that has to be depreciated over longer periods of time, like decades. Real estate is amazing, but being able to entirely write off depreciation expenses in year 1 through bonus depreciation is incredible. So if you want to learn a little bit more about oil and gas and Bitcoin mining, you can book a call with my tax strategy team below. We'd be more than happy to discuss it. Next is cash balance plans. A cash balance plan is a type of employer-sponsored retirement plan that combines features of both a traditional defined benefit pension plan and a defined contribution plan like a 401k. Now, business owners or self-employed people can subtract their contributions to these plans from their taxes as a business cost. Whoa. This often lets them deduct much of what they put into their 401ks or their IRAs as a active deduction for the year. So for example, if you had a defined benefit plan or a cash balance plan, you can deduct up to $300,000 or more per year based on things like your age or the time until you retire. Also, it can lower your taxable income substantially, sometimes to even zero. Employer payments and any earnings from investments grow tax deferred inside of these vehicles until you take the money out in retirement. This helps them grow faster over time. Employees or plan members also don't pay taxes on their benefits until they withdraw it in retirement. You can usually pick between regular payments like an annuity or rolling it all in to an IRA. Pretty awesome. This gives you more control over when and how much you want to pay in taxes. Now, pairing this with a 401k or similar allows even bigger total payments and bigger deductions. It can also help you get that 20% QBID deduction if you're self-employed, that's Section 199A, by reducing your income in order to qualify for the QBI deduction. Whew, we got a little complex there at the end. Okay, guys, that's all I got for today's video. If you like what I'm teaching on this channel, let me know what you think by commenting below. If nothing else, be on the lookout for our tax-free wealth challenge. We run these challenges every quarter. It's your opportunity to spend 3 to 5 days with me to learn advanced tax strategies in a closed setting. If nothing else, I hope you enjoyed this video. Go ahead and like, comment, subscribe. We look forward to seeing you on the next one. Cheers.